Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking oil majors, and my guest is Aaron Anderson, Senior Vice President of Research at Fisher Investments. Brent crude has been moving higher again in recent days as fear grows that the risk of escalating conflict in the Middle East could disrupt oil supplies in the region. That's not the only driver of higher prices, though. US stocks of crude have been falling since the height of the pandemic, and OPEC Plus continues to maintain supply cuts. Concern about a global recession still weighs on the demand side, though, and the majors are lagging behind the wider market. This is the S&P Energy Sub-Index, up just 3.7% year-to-date, compared to 13% for the S&P 500. They've been unfashionable in recent years, of course, as the IEA says there can be no new oil and gas extraction if the world is to meet its climate goals. Well, to drill into those oil majors, I'm joined now by Aaron Anderson of Fisher Investments. Aaron, hi. We have had a volatile few months in the crude markets, but I know you think that the oil majors can weather a substantial amount of volatility.
Yeah, that's right. First off, very nice to speak with you, Elena. As I think about the energy complex from an investing standpoint, there are really a few different types of energy companies. You've got your pure play upstream companies, which will be things like exploration and production companies and drillers and servicers. They are going to be very oil price sensitive. In the midstream, you've got transportation companies. Those almost tend to be more of a yield play than a play on the resource itself. And then in the downstream, you've got refiners. And so they're going to be more sensitive to things like crack spreads and refining margins. The nice thing about an integrated, the oil majors, is they do a little bit of all of that, hence the name integrated. They've got upstream activities, midstream activities, downstream activities, which makes them less oil price sensitive than some other parts of the market. But that doesn't mean they're entirely immune from the vagaries of oil price fluctuations. And so there is some influence there, but just given the very diversified nature of their businesses, they'll tend to be a little bit less oil price sensitive than other segments of the energy complex.
We've seen a big takeover announcement in recent weeks in this space, Aaron, as ExxonMobil announced its intention to acquire Pioneer Natural Resources. What does that tell us about the oil space at the moment? Will we see more of this kind of consolidation?
Yeah, you're right. Quite a large acquisition there. I think it tells us a few things, but specific to the energy complex, especially in the US, if you want to grow in areas like the Permian Basin or Texas or elsewhere, you almost have to do that by acquisition. That's what the Pioneer acquisition was all about. If you want to pick up real estate and grow production here, you have to do that via acquisition. So to the extent oil majors are interested in doing more of that, I would expect to see more M&A activity. But the real growth engine has been outside the US. It's in places like Africa and elsewhere. Those tend to be more traditional exploration and production projects built from the ground up versus growing via acquisition. So really a lot of it just comes down to where do the oil majors want to grow their production? Inside the US probably means more M&A, outside the US less so.
What about the downside here? Aren't oil companies vulnerable to demand falling in a potential future recession?
They are a bit, yes, but I will say, there has been a bit of an OPEC put, so to speak. I mean, clearly OPEC has shifted its focus from a decade ago when they were very focused on maintaining market share and less concerned about price. Now they seem to be extremely focused on price. And so barring a big recession, just a mild one, I think there's enough adjustment that can be made on the supply side of things to keep prices at a fairly healthy level.
ESG concerns, Aaron, have put pressure on institutional investors in particular to divest from some of these big oil majors, especially the more they're investing in further exploration, production, more drilling. Do you think that could weigh on their shares going forward?
Well, I think those types of sustainability discussions are having multiple impacts on how the companies are operating fundamentally, as well as how you put it as demand for their shares. You're right that we do increasingly see large institutional investors moving away from fossil fuels in some parts of the world, but I wouldn't say that's everywhere. In the particularly ESG focused parts of the world, like Europe as an example, we see that quite frequently. It's much less common in the US, less common in Asia and the Middle East and elsewhere. And so I don't know that effect is widespread enough to really dent demand for shares in some meaningful way.
From an investor perspective then, how should one pick and choose in the energy sector? Is bigger always better?
Well, a lot of it does come down to your view on the commodity itself. I think in an environment where oil prices and gas prices remain fairly stable, I think the oil majors make a great option there. And they tend to have lower costs of production. They can be extremely profitable with oil prices at these levels, but they probably don't benefit as much if you think oil prices are going to really shoot higher. And so if you've got a very optimistic view about the resources themselves, probably playing more at the upstream side of things is a way to play that. If you think that oil prices will remain stable but still very profitable, then I think the oil majors make a lot more sense.
Aaron Anderson of Fisher Investments, thanks so much for that analysis. Well, that's your roundup of the energy sector. I'm Elena Casas, and this is Reuters.